Small caps, relative outperformers on the major averages today. Overall, though, the Russell 2000 has lagged the broader market down 17% from its record high hit in early November. Joining us now is Carey, Bank of America, head of U.S. small and mid-cap strategy. And Jill, not just today, but for the entire week, small caps are actually higher by more than 1%. Everybody else ending with declines. Why do you think that is, that we've seen a turn after they've underperformed for so long?
Yeah. Hi, Sarah. Thanks for having me. Look, we've been positive on small caps relative to large this year. And a few weeks ago, we wrote about the sell-off and how we think that the worst could largely be behind us for small caps. I think a lot of the risks have been priced in this point. You saw the relative price to earnings ratio of small caps relative to large caps fall to levels that was really below what we saw during COVID, below what we saw during the financial crisis, really levels that we haven't ever seen except for during the 1998 to 2001 period, after which was actually a really great decade for small caps. So I think around COVID, around Fed tightening, a lot of the risks that are out there in the market, we've really seen reflected in small cap valuations at this point. And I think if we are seeing, a more positive backdrop with respect to COVID cases turning the other way, that should be supportive of services spending, which benefits small caps. The pickup in CapEx spending should also be relatively more beneficial to more domestic, smaller companies.
But the yield curve is flattening, Jill, and there are increasing worries about recession and a real economic slowdown the tighter the Fed has to get. And the theme of the week is the Fed has to get really tight because of inflation. Wouldn't that be bad for small caps?
Look, I think if we were going into a backdrop that we're expecting a recession, which is not our base case, then yes, small caps do tend to underperform during economic downturns and downturns within the market on a substantial basis. But if we are in an environment where even despite the yield curve flattening, we've actually found that in bear flattener environments for the yield curve, small caps have outperformed large caps. With the Fed tightening, usually small cap multiples have compressed more than large cap multiples. But, again, I think with the amount that small caps have derated in terms of their multiples compressing leading into this tightening cycle, it's been much more than usual. So I think they're already been reflecting a lot of the risks around that. And we've really found that long rates are more correlated with performance and matter more than Fed funds rates. So there's been virtually, no relationship between small caps relative performance and the Fed funds rate. Whereas if the 10-year yield is rising and that's in the context of a still supportive economic backdrop, that's generally positive for small caps.